All right. Good morning. Good morning. Sorry for the late start. I was doing a little research for you guys and got carried away trying to find some stuff and looked up at the clock and realized that we were running just a minute late to get started. So I apologize for that. But we're here and we're ready to go. And I want to talk to you a little bit about the markets on the long term basis. Once again, we're just going to kind of look through this and talk about where we think this market's going and why. And then we're going to go in and look at our individual positions that we've been putting on. And I've got a new spreadsheet that I'm working on. I want to I'm not going to give it to you right now because it's not done. So I just want to show you what I'm working on. And then it's something that you can have once I get it done. And of course, the only thing you have to do to have it, it's free for everybody who has Pit News Magazine. So if you're a subscriber to Pit News Magazine, it's free. If you're not a subscriber to Pit News Magazine, well, then you can't have it. That's the way it works. Pit News Magazine is it's only $20 a month. Right now, it's on sale. It's regularly $39.95, but right now you can get it for $19.95 for a whole month. I mean, a whole month, a whole year for $19.95. So that's 12 issues, and it's a beautiful magazine. Everybody should have Pit News Magazine. But I'm going to give you the spreadsheet through your Pit News Magazine subscription. And so I'm working on that, and I'm going to get that, and we're going to pull it up here in just a minute. But what I want to talk to you about right now is I want to talk to you about the Flushing market. I'm getting text messages that are waking me up in the morning. Oh, no, everybody's dying. The whole world is coming to an end. We predicted this. Come on, you guys. We know what's happening. We know this was coming. We knew it. It's in the mathematical models. The market's just working out its same old patterns, its same old strategies. It's just the same old playbook. All right. So let's go through and talk about that just a little bit because everybody's freaking out. I'm just like, come on, come on. I told you the market's going to come down to this little blue line right here. That's 480. I think about 475 on the S&P is our target. Now, could something happen that cause it not to come down that far? Yeah, I mean, you could get a little bit of a bump like this, which is probably what'll happen. But I'm more likely expecting something like this. All right. I'm expecting the market just to kind of flush on down and come on down here, just like a train on rails. Right. I know I use that saying too often, but nonetheless, that's where I think this thing's coming to. So we got a little bit more coming down here, and that's just going to fulfill our Fibonacci bow tie. All right. So that's a mathematical model that's built into all the algorithms, and that's what they need to do. Why do they need to do that? Why does that market need to flush like that? And isn't it having something to do with the tariffs? Isn't it having something to do with Trump's being in office? Isn't it having some? Yeah, you can blame it on all those things, but you've got to realize that the big banks, the hedge funds, and let's just call it what it is. It's BlackRock. All right. BlackRock owns all the money. The only money they don't have is what's in your pocket. BlackRock is famous for their algorithm. All right. If you go do a little research on the internet and talk about, and you can do research on BlackRock's algorithm. Now, I say BlackRock, but there's also Vanguard, and you've heard me say this before, and State Street. There's those three giants. All right. Those guys are three giant organizations. They own all the money in the whole world. They own the whole world. They do not like that the United States is trying to, become more of a trying to get out of debt, I guess is what you could say. Donald Trump, they don't like what Donald Trump's doing. They're an international, worldwide banking system. All right. They need the whole world to do well. For them to do well, they don't like to see one country do better than all the rest. But nonetheless, that's not really how they make money anyway. So they don't really care. They kind of have their political views, but they run everything on a mathematical modeling system, and it's all done with computers, and it's not even AI. They don't need AI. They've got this mathematical system. They got a computer that they've been trading like this for eons. All right. They've been trading like this forever. And it's just how they run the market. And because they have so much money, they have so much control over the market. Are there things they can't control? Yeah, there's a few things that they can't control. They can't control you and me, but actually they do control you and me. You and me are robots to them. All right. And I'm going to show you why. Here you go. Let me pull this up. This is called the fear and greed model. And we've talked about this before. We talk about this in class at the university all the time, almost every class to the point of nauseum. All right, but this is the fear and greed model. And this is how they manipulate you. All right. This is how they get their way. So, what they do is they cause the market to run. And this is where they get into the market. They start right over here with optimism after a big downtrend, right? So, you start over here, we start over back over again. It's just one big cycle. And this cycle is how they run us, they control us through this cycle. So, they start off with optimism. We start to buy. We like to, and as I said before, we as small speculators, we like to buy high and sell higher. That's our favorite thing to do. I know we've all been told to buy low, sell high, but we don't do that. Why? Because we're a bunch of lemmings. All right. We do what the big banks tell us to do. They have taught us, they teach us, and it's really hard for us to not do that because that's what we want to do. It's what we've been trained to do our whole lives. We've been trained to do the wrong thing because they want to take our money. All right. We are robots to them. We are lemmings. We are the ones that they want to take our money away from us. So they teach us to do this. So here's how you give us money. That's how they do it. All right. So we go in with optimism and we see the market start to go up. So we get enthusiasm and then we get exuberance and then we get euphoria. And the market is right here at its highest level. And we are just falling in love with trading. And we think trading is the best thing. And we run around and tell our parents and we go around and tell our wives and our kids and oh, we're just so happy, I'm just so rich, and I'm just, I'm just such a euphoric feeling, right? And you've all been there. You all know that feeling. And then when the market starts to roll over the top, what happens? Oh no, we get a little bit of anxiety. And then we go into denial and we're like, well, it'll come back. I know it will. I bought up in here. I bought a whole bunch at the euphoric stage. And so this is where we like to buy. We start to buy here at optimism. We load up again at enthusiasm. And we even buy more at exuberance. And then at euphoria, we back the truck up and we sell the farm. I mean, we're buying into this market like it's just like we're going to be rich, rich, rich beyond our wildest dreams. And then we suddenly come into this anxiety stage. And then we go through denial. Oh, it's going to be a temporary downtrend. I'm in it for the long haul. Down we go, fear. And then we get a little bit of despair. And then we start to panic. All right. Where are we at in today's stage? All right. Let's take this model and look at it over here. Let me see if I can put those up next to each other. Look at this. And I'm telling you, this is a real thing. This isn't just something we made up. Look at this. And then look at this. And look at it over and over and over and over again. All right. It happens on every chart, whether you're on Apple, Amazon, Netflix, Google, Tesla. It doesn't matter what chart you're on, you're going to see this pattern. And this pattern is created on purpose with these computers, with these big algorithms. It's not even AI. It's just an algorithm. So what we do is we can watch these patterns come through just like this. All right. And so this pattern comes through. And where are we at right now? We're coming down off of this point right here, right? This big point right here. Now, if you look back here, we went through this again over here. So this point here was where we had our greed, and this is where we start to buy. And then the market comes down and we buy all the way up this uptrend. And then it comes down. We go through fear, despair, panic, capitulation, discouragement. And this is where we sell out. All right. This is where us, the lemmings, we all sell out down here. We get out of the market. We're supposed to be buying in down here. Buy high, sell higher is the way they want us to do it. Right. So we buy here in anticipation of selling higher. But we're supposed to be buying low, selling high. But we don't do that. Well, you don't do that. Why? Because we go through the fear, despair, the panic, the capitulation, the discouragement. And then what happens? This is where we sell out. And they know that. They know this. You think that these banks and these hedge funds and these guys with these great, big, huge, deep pockets and billions, not even billions, some of these guys have trillions of dollars that they manage. All right. They know this. They have psychologists on their staff. They make this happen. All right. And so this is the euphoria stage. Then we come down into here. This is where we sell. And then the market starts to come in. We start have a little dismay, a little hope, and then we start what? A little relief, a little optimism. We start the whole thing all over again, and we go through the optimism stage, the euphoria, exuberance, euphoria again, and this is where we just start loading up right up in here. This is where we buy like crazy, all right? And that's exactly what they want you to do. Why? Because they want to take all your money as you sell out all the way down this trend. As you go through fear, despair, panic, capitulation, and discouragement, you come down here and you hit fear and you hit sell. All right. And that's where they buy, and that's where they take all your money. So they need this to happen. Why? Because that's how they make money. So what happens is they buy when you're selling, and when you're selling, they're buying. All right. So if they're down here and you're selling, they're buying. So they're going to buy everything that you're selling out. Everybody's selling out right here because of the denial, the fear, the despair, the panic, the capitulation, and the discouragement. We're going to roll out of this thing. And the reason this is going to work, and you wait and see, mark my words, it's going to come down here, and how far they bring it down, we don't know. All right. I'm going to bet it's going to come back down around somewhere around this previous high. And why? Because that's where they've done it before. If we go back and look in time and you look at these charts and you look at all these just Apple, Amazon, you go look, they generally always bring it back down, let it fall down to this previous high. Now, I've seen it fall lower and I've seen it come in and start to rally a little bit higher, but they run this pattern over and over and over again. I call this pattern the Fibonacci bow tie. All right. You've heard me talk about it because we go from this point to this point to this point to this point. And it's going to come down to here, you guys. So don't freak out. I know you already have, because I'm getting text messages from everybody. And so that's the freak out that's happening. And I just try to explain to you. And of course, the people who are freaking out and sending me text messages don't come to my classes, so they don't get these lessons. All right. So I have to teach people. All right. So this is how this works. Now, this is going to come down and it's going to roll. And the reason it comes down here and rolls, let me show you. I got another picture for you, a little bit more detailed, is because this is where they start to accumulate their shares and they start to make money on us. All right. So this is the model right here. And you can see it. It's just like a train on rails. I mean, I know I overuse that saying, but it's so true. Look at how this market goes through this pattern. It comes in, we go through the accumulation stages right here. The market pops. They pop the market. It goes up, 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 up. And then they go through another accumulation stage like this right here. See this? And then they pop it again, pop, 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 and they bring it up here. Now, up in here, we didn't have much of a distribution. They turned it around and went straight down. So flush down right here. This is our flush right here. Look at this. This is where the first stage of the flush. Now, sometimes it'll come down, it'll go sideways like this, and they'll flush it again. So we've got some possibilities. This thing could come down to these blue lines down in here. There's another line right in here, an area of support. See that right there? That's another target spot they could bring this thing down to. And it depends on how much they want to punish the punish Donald Trump, punish Elon Musk, because these guys, they don't like that. BlackRock, they don't like the Trump administration. So do you think they're going to help them like they helped the Biden administration run this market up like this? No, they're not going to do it. But they also have their own self-interest in mind. And there's also 3 or 4 of these great, big, giant, enormous companies, and they want all of their money too. They're not friends. They're like frenemies. All right. They do, and they're not supposed to. It's against the law, but they talk to each other. And they all know what's going on. They have their Bilderberg meetings or whatever you want to call them, right? And they get together and they decide what's going to happen to the world and how they make their money. So they're going to bring this thing down. And then we're going to go through another stage like this. There's a possibility we could go through another flat stage and even another down here. They could bring it all the way down and match this level here and turn around. And that's where they're going to start to accumulate. And that's where they start to run the market one more time. All right. This is an example of that. And they're going to bring it down in here and then they're going to run the market again. And that's how they make their money. Because if they can get you to sell out, you got to sell to them so that they can buy. For one buyer, for every buyer, there's got to be a seller. And these guys are so big. a couple of sellers isn't going to do it for them. They need the whole frickin' world to sell to them. All right. Because they're so big that if they don't have everybody sell to them, they can't make money. And they need to make a lot of money because they got a lot of overhead. All right. They're big outfits. So they bring the markets down like this and they just let them tumble. And they let them tumble and they help them tumble. They help it happen. All right. So they bring these down and then they accumulate and then they turn around. And then what happens is they bump the market like this. They do it on purpose. It's all algorithmic trading and they bump it when they're ready to start to buy or when they're ready to start to run the market back up. They do it all over again. And it's just a cycle that they run the market through using these algorithms. And they do that for the purpose of buying low and then they sell out all the way up the uptrend. So these big banks and hedge funds, the key secret here is they buy down here. All right. They buy down here. And then we buy all the way up the uptrend. That's what we do. We're the lemmings. All right. They call it feeding the ducks. They even have a term for it. We're the ducks and they feed us. And what do they feed us? They feed us everything we want to eat. And they have all of their shares down here. And then they feed us as we buy. And we go through our state of exuberance, right? And they take us up through this state here and they get us into the optimism. They get us into the euphoria and into the enthusiasm, exuberance, euphoria. And they want to bring us up here because this is where they want us to buy up in here. So that they can then take all our money on the way down as we sell out and they can buy it all in down in here. And then they turn around and run it. And then they sell all the way up that uptrend. So they're selling. So look at this. If they bought all their shares here and they sold all the way up here, they can't make any money up here. Why not? Because they don't have any shares. They sold it all to us. And that's where we hold it all. We hold all their shares right here. The whole community of retail traders holds all our shares right here. And now they're going to let this thing flush and we're going to sell all of our shares out all the way down here. And you'll say, I'm going to hold on. I'm going to hold on. I'm going to hold on. Well, they'll just keep going until then nobody can hold on anymore, until there's the only people left that can hold on are those who will never get out. But they'll shake everybody out the best they can. They'll get everybody they possibly can to shake out. And they'll take your money and they'll take your money and they'll take your money and they'll build up a great big huge position. And then they sell it all the way up the uptrend on the next leg. And that's just the name of the game. That's how they trade and that's how it works. And we fall for it every time, just like a bunch of lemmings. All right. And we even know the strategy. We're like, oh, look, this is the strategy. And we do it anyway. So there you go. All right. That said, I've said that I just keep saying that in almost every class because it's so important for you to know and understand. And I just get so many text messages and people calling me and saying, what are we going to do? We're going to die. I'm telling you, we are in the stage right now. We're in the fear stage. And I don't know if we've even got to despair yet. We're certainly not at panic yet. You wait, we'll get panic, capitulation, discouragement. The end of the world is coming. Jesus is on his way. Get your 2 years supply of food. And then it'll start to curl and we'll start to see a little hope and then relief and then optimism once again. All right. It'll come around. Promise. Happens every single time. It's all one big mathematical game. And so I tell you, you think I joke when I say it's a carnival game. This baby is one great big carnival game. And the big boys, they just sit and laugh and laugh and laugh. They think it's so funny. They just think it's so funny. In their board meetings, they sit around and laugh and drink beer. I don't know what they do. I've never been in one. But I can imagine. Just sit around. I would sit around and laugh and laugh. All right, here we go. Let's go look at our markets. All right, this is our portfolio. And you can see this is the YouTube class portfolio. And these are all of our stocks that we had. We had the Magnificent Seven. And so Apple, we took off one position. Let's see. I think we took some of these off today. Apple went off today. So let's just look at the individual chart. Now we had on here If you remember, we put on a bunch of straddles. Yes, straddles. So we just put straddles on every single Magnificent Seven. And the first thing we did, our first test, was to just put them all in there and say, all right, we're going to take them all off at 25% profit, right? Remember when we did that? And I wanted to show you that you can do that. And then the next class, we came in and we followed up with a little bit more advanced strategy. And we went back and we reset how we're going to take these off. We're going to take them off based on implied volatility. So if you haven't seen those videos, go back and watch them, because they show you how to place your profit taking strategy based on implied volatility. And instead of just saying randomly, oh, I'll take it off at 25%, right? Because we need to have apples to apples. And Tesla might have a much higher volatile market than Apple, for example. And so you have those two markets. And if you're both taking them off at 25%, well, Apple might have to move a whole lot more than Tesla to get you your 25%. And that might not be in the cards. So by lowering your expectations based on implied volatility from the options chain, which is this column right here, implied volatility, you can better decide how much money you're going to take off the table with each position. Okay. So that's how we did that. And then to follow up on that, we're going to come in here and we're going to come in and look at what we've got going right now. So if we come over here to our closed positions, this is Apple. You can see that we know it came off, that we got our profits because it's not active anymore. So we got paid. So we can come down here, and I think most of them got paid today. I think we might have had one or we'll have to go look. Might have come off yesterday, but this was today's, and so we got paid $430. So that was our target. My goodness, I'm losing my voice. Hold on. All right, I got both hot tea and I've got my cold lime water today. So hopefully I can keep my voice going. So uh, where were we? All right, we're on Apple and we made $430. So let's come down. We'll go to Amazon. And well, Amazon is one that we had one on, and we took those profits off yesterday. So they don't show up in our closed positions. Their profit is going to just show up over here in our dollar amount. And that's another reason why we need to have a calculator or a spreadsheet to track these things for us so we can know what we're doing. But if you're in the real money, of course, it's going to be in your real money closed positions. So you can go over and look at them there on your that little paper they send you, the little PDF they send you every month. What do they call that? Statement. So you'll see it on your statement, but it doesn't show up in here because they clear everything out every day for a new set of books. All right. So then we're going to come on down here. I'm going to skip Bristol Myers because that is not one of our Mag 7, and it's not one of the ones that we have a straddle on. This is one that we have a poor man's covered call, and we're going to go into those in greater detail today because that's what I have on my spreadsheet that I'm going to give to you, is tracking that one. But we need to start tracking our others too. We need to track our straddles too. So come down to Google. Google is another one. We took this one off today. So we got our $250 on that one. So that was just our profit taking strategy. All right. We're saying, well, if we make $250, we'll take it off. And then we got Meta that's come in here. Now Meta is still running. Look how far we're up. $1,500. Meta had a higher implied volatility, so it hasn't reached our target yet for profit. So it hasn't taken that off yet. You can come in early and you can say, oh, well, I made $1,500 and this market's dropping, and maybe I don't think it's going to drop anymore. It will turn around and start to come back up. I want to take that off right now. You could certainly do that. There's nothing wrong with that. Nothing wrong with taking profits. But if it continues to fall, you'll feel bad. All right. So it's like we were talking yesterday. When you're trading, it doesn't matter what you do, you're going to feel bad. All right. You're going to feel bad if you get stopped out and you lose money. You're going to feel bad if you get out early, or if you get out and take profits because, oh, heck, I could have made more money. All right. So it's fear and greed. Fear of not making as much as you could, or fear of losing money. It goes both ways. And greed is what makes you lose money because you're like greedy. So you stay in hoping you make more money, when in reality, what you're going to do is lose the money you have. All right. So greed can be good and it can be bad. Fear can be good and it can be bad. So just realize that that's the state of mind of a trader. You're always feeling like one, either you're losing money or you're leaving money on the table. It's just the nature of the beast. So you always feel bad when you're trading. I promise you, winning never feels as good as losing feels bad. They're not equal. Winning feels good this much, losing hurts this much. So it's not ever equal. Feel good doesn't feel, it's not like that. It should be, but it's not. Whenever you lose $20, you feel terrible. When you make $1,000, you're like, whatever. Okay. So here we go. That's meta. Do we want to take it off? We can take it off. Why don't we clear it? We can take it off. So the way you do that, you just come in here. We'll delete the pending order. All right, just by clicking on that little icon and saying delete. And then we come in here. The easiest way is just come over to your options tab and just say exit chart options. So you just hit that. This will close your options position on this chart. You say yes. It says, do you want to do the bid ask spread, or do you want to try and bid for it at the midpoint? If you're in the real money, I would bid for it. See if you can. It's kind of fun. It's going to save you, maybe $2 or $3. Or you can follow Doc Brown's recommendation and just say, screw it, I just want out. So there you go. You're out. And so that just took us off here at Meta, and we just made $1,300 on that one. All right. Now, it wasn't like we just made it today. We did put that on about 4 days ago. So it did take us about 4 days to make $1,300 on Meta. So now we're going to come down to Microsoft, and Microsoft came off today all by itself. That one made us $460. And we got NVIDIA. We're still in NVIDIA, and it's flushing down like a toilet down through the third drive pattern. So this is X1S A1. This is X2S A1. And we're coming down here. That blue light's got to intercept. And then down in here, we'll have X3S A1. And that is, as we have said in the past, oh my goodness, do it right, Lynn. Delete notes. Okay, so in here, we're going to come in and we're going to say this is a 25% chance that the market's going to rise on an X1S A1. All right, so that's our probabilities. The chances that the market's going to rise on an X2S A1, oftentimes I just say about a 50-50 chance, but it's more like you're holding a 17 at the blackjack table. There's actually, I'm going to come in here and I'm going to say it's more like a 55% chance that the market's going to rise on one of these. 55% chance, a little better than half. All right, and then down here, it's more like a 75% chance that the market's going to rise, and this is going to be the bottom, and you're going to turn around the market on the X3SA1. Doesn't mean it can't go to X4SA1, X5SA1, X6SA1. Certainly can, but generally speaking, once it gets down into the third drive, that's the end, and it turns around and goes back up. We get a 3-drive pattern. Again, doesn't mean it can't go 4 drives, 5 drives, 6 drives. It happens, just not very often. So that's your 3-drive pattern down, and that's what we're looking for. We'd like to see that thing turn around at the bottom of the X3SA1 at this point. All right. And that will probably be when the S&P is down here somewhere, touching this little blue line down in here. 481 is where that blue line's sitting. All right. So 485 is our target price for the S&P. And it's flushing down. Now the S&P is still on a 2-drive pattern. All right. So it's, see, this is a little double top. This is our first drive down. We got our counter trend. We got our second drive down. So we're in, on this one, we're only in an X1S A1. Again, 25% chance that that's going to be the bottom. Real low. You're not going to get a bottom on. We never buy the X1S A1 in anticipation of a rebound. All right. Just don't do it. And then this one here, again, we're going to come down here to the X2S A1, and it's going to be like a 55% chance. And then remember, we've always got that, X3S A1 looming down there that we could drop down to. And so that thing's coming and looking like it wants to drop one more time, and that's where we're at. We're dropping one more time. It's predictable. We all know. You were here. You've been in my class. We've done this. We've made these projections. This is not a surprise to you. All right. So you've planned accordingly, I hope. And so the only markets you should be in, if you're in at all, are the hedged funds, the ones that are paying you a hedge. And the yield max funds are hedged. So in mine, I'm still into a lot of the yield max funds. I kept my yield max positions. I got rid of all of my when it came up into this region here. I got rid of all of my. In fact, I think it was a little early. If you come down to the daily, the S&P, I think I got out right in, started getting out right up in here, and then it kind of went like that, and I felt bad. I thought, well, maybe it's going to go up to another drive. So we got drive 1, drive 2, drive 3, and I got out. And then it started to do this. It started going up into what looked like another drive, and I was like, oh, maybe I was wrong, but then I wasn't. And then I was right. And so I got rid of all of my long, just growth funds, all my growth right in here, because the odds of that going up got really low. So I got out of all my growth, and the only thing I have are the hedged positions now, just the yield max funds that I have in there, and I've talked about those at great length. And those are all hedged because they make money on the way down. Now they don't make, this market's really flush and fast and hard. So it's been hard for them to maintain, but they have a hedge. All right. They're hedged in the sense that when the market goes down, they still make money on selling covered calls, and those premiums will help cover the losses. My portfolio right now is sitting at about 0. All right. 0, meaning that I haven't made a penny in the last 2 months, but I haven't lost any money either, because my hedge, the way I'm rotating it, I'm triple, I'm tripling up on the roll. So I roll it into one, next, the next, the next. So I get paid my dividends every week. All right. And whatever I get on this dividend, I roll into the next dividend. It's like a quad compounding strategy. And if you go look at I think it's in either this month or last month issue of Pitt News Magazine, there's an article in there talking about pairs trading and how to do that. And we actually run an example on Microsoft showing you how you can quad triple up your dividends. And so that's what I've been doing. And because I've been doing that, my dividends have been keeping up with the losses. So my portfolio right now over the last 2 months hasn't lost a thing. I'm still, I think today, this was a nasty drop today, and I looked at it before class, I was still positive. All right, believe it or not. I haven't lost a penny. Because of the way I've been managing my positions, I haven't lost any money in the last 2 months. I haven't made any money, but I haven't lost any. So you can do that too. All right. And if it goes underwater a little bit, and it has a couple of times where it actually dipped, and then I got the payments and it brought it back, and it'll dip underneath and making losing money, and then the payments come in and it brings it back. So I've been playing that game where it drops below and then it brings it back, drops below and it brings it back. And so you just have to keep playing the game until it comes back around, and eventually we'll get down into this, into our zone of where everybody else is selling, and we'll start going into dismay, hope, relief, and optimism. And because we've been playing this game, we're buying all the way down. Then when it turns, we'll be rich, rich, rich beyond our wildest dreams. Unless the market doesn't turn around, nothing says that the stock market has to go up ever again. It could just keep going down, 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 down until the United States goes bankrupt. If you think that's going to happen, then, plan for that. Go get more cans of peas. So there we go. So that's what's happening for my portfolio right here. And this is what we're looking at. This is the S&P on a daily chart. Of course, we've been looking at it on the monthly chart because that's easier to see. But that's the play on the daily chart. So that's where we're at. And that nasty drop right there, very painful. But today's payday for me, and I get another big chunk of money coming in from my dividends or from my hedges. So I'm happy about that. All right, let's come in and look at where did we get to? NVIDIA. Oh, we did NVIDIA. Did we do NVIDIA? Well, it's up $175. It's still dropping. We still got our order in there. We're still in good shape. We're still waiting for that one. Palantir coming down. We still got our order in there. We're up 230. We took our profits off. Did we have one in here? I think we did. I think we took our profits off on this one the other day. And then Tesla, it's still, our position is still open. So we're up 520 on one and 210 on the other. It's giving us 725. And it's getting ready to break that next Where are we on Tesla? So on Tesla, we really got slammed on this X2 SA1. It really was way bigger than we anticipated, but we're going to measure it and we're going to see where it went to and see if it's out of line from the mathematical formulas. All right, so let's come in here. This is our X1S A1. And that's that break right there. Again, lousy 25% chance that's going to be the bottom. And then we come in here, and this is our X2SA1. X2SA1. And that's what do we say? 55% chance that's the bottom. And then we got the next leg down here, and that's our next little shelf right there. See that? Little blue lights coming up, natural trend line. It broke that today. It's hitting the blue lights today. And so now we're headed into X3SA1. So how far down is that going to go? They're punishing poor little Tesla. Poor Tesla's getting punished. Let's come down here and we're going to go off of this projection here. We're going to go up and see how far. Look at that thing went all the way down to the 200% projection. Now, is that out of normal? It's not normal, but it's not outside the realm of normal. Okay, it's not too unusual to see a market fall that far on that strategy, because it wouldn't be on the mathematical reverse engineered calculator if it wasn't something that was built into the algorithm. So the algorithm, see that? Look, it went right down to 200% like a train on rails. I said it again. Somebody come up with another saying that I can use instead of that. Something else that happens perfectly all the time. All right, so that's your ABC top formation, and those are your Fibonacci projections down the scale of how far the algorithms are willing to take it. Look at what happened right here at 100%. I mean, it's just, you can reverse engineer what they're doing. There's your next little shelf, and flush one more time. They're like, let's let her go. Let's let her go again. And down she went one more time. That's a punishment right there. Look at that. And that's BlackRock. It's BlackRock doing that. Now BlackRock makes money off of Tesla. So they're using this as an opportunity to load up on a whole bunch of shares. So trust me, BlackRock is buying a lot of Tesla right now. BlackRock, Vanguard, and State Street. When I say BlackRock, I mean the whole group of them. They're all loading up. Trust me, they're all loading up. What they're trying to do is they're trying to use this as an opportunity, and the bad press that Elon's been using, they use it in their favor. You think they're not that smart? Oh, you bet they're that smart. That's why all of these things work right around the fundamental news events, and that's why these reports, you can sit there and tie them together, because they run their algorithms to perform at moments in time where the news is. And so they can take advantage of those news events and run these algorithms against it so that they can get the people, us, the ducks, the lemmings, to play their game. And that's the best way. And then, of course, they feed all that information into the media, and the media is their spokesperson. And they run out there and tell the media what to say. And so the media scares you, so you sell out so that they can buy your shares. They do that. And if you think I'm lying, I got a video of Kramer from MSNBC, an actual video of Kramer telling people that that's exactly what they do, teaching guys in his class how to do it. All right. I've got videos. I saved them because I'm sure they'll take them off the internet, but I've got videos of him, and I've actually published those in Pit News Magazine. So you can go back in some previous articles and watch those articles, watch those videos of Kramer, Kramer on MSNBC teaching a class to hedge fund managers on how to manipulate the markets, exactly like I'm telling you. So if you think I'm making it up, I'm not making it up. All right, so here we go. This is coming into the X3SA1 down in here. And where that's going to turn, well, we don't know, but we can make a projection, all right? We know that the guys are going to come in here. This is one big long projection down here off of that one, and then back up to this point here. And this is the next where we're trying to reverse engineer where they're going to send that thing to. How far down are we going to go? We don't know. Is it going to go to 50%? Are they going to send it all the way to 61.8, which is a favorite number, right? That's the golden ratio. So we could come down here. We could go off. That's generally how we calculate this, is off of the top of the last leg, which is way the heck up there. They might not run it down that far. We could come off of this one here, just off of this leg here like this, and probably a little bit more conservative. Again, we don't know what they're going to do, but it's a mathematical algorithm. And so we can measure where we think that market's going to come to. Now there's 61.8 if we go off of this peak right here. So I'm going off of this high. And that's how they do it, because it's all math for them. So they go off the previous levels of support and resistance, and then they measure and project. And then they come in here, and this is what this little Fibonacci projection tool does. So we're going to go off this blue line as the high rather than way up here at the C, because that was a nice little ABC pattern right there too, right? It just didn't break the mathematical model. So we go like that. See that? Come right down to 130.9. It's just these numbers all come together. And the reason they come together is because they make them come together. They control the market. That's why when it comes down here and you say, well, look at that, 200% is exactly 130.9 when you come to that other level. It's all geometry and it's all mathematics and it's all calculated out. All right. We are just trying to reverse engineer their algorithms. And so you can find the patterns in their algorithms, and then you can figure out, kind of make scientific wild ass guesses what they're going to do, where they're going to push the markets and where they're going to come to. So if this is the next level, see that 130.9 is a golden ratio number. 130.9 on the downside and 61.8 on the backside. So 61.8 and 130.9 are the same. They're just one's projection, one's retracement. So those are favorite numbers that they like to run things to. Of course, 200 is also a big number, but 161.8 is a big number. Right? So these are numbers that they use in their algorithms. And so they come down, and we know that because, well, I know it because I worked at the Chicago Board of Trade. And I listened to them tell me. they told you. I listened to the big boys teach that stuff. That's how I know. So we come down here. This is 100%. 130.9 is down here. So you got your golden ratio. Now, are they going to let Tesla fall all the way down here? I don't know. They might. Depends on how much punishment they want to give Elon. And it might depend a lot on where the S&P goes, because it all works out with the S&P. Remember, the S&P is the overall big Mac daddy of them all. So, and it's still flushing. Look at that, still flushing. So it's got to come down to 479. Now, are they going to let it flush all the way to 479? We don't know. We don't know where they're going to stop it, but they control it, not us. And just how far are they going to let this thing go? And they want to do that so that everybody gets out so they can buy all your shares so they can ride it back up. That's how they do it. Man, it's a big flush today. Look at that. They're getting their way. Everybody's selling out. Everybody's jumping out like rats off of a ship. It's crazy. Craziness. All right. So Tesla's going to go with it. How far are they going to take this thing down? Depends on where. The S&P is going to end up somewhere around 477, and Tesla will be part of that. So Tesla will be down in this region here somewhere, probably. We got this bottom right here, and I'll have to break the bottom, right? So the bottom is the line. We'll see if it'll come down and break that bottom. But if it breaks that bottom, it's going to already break the blue lights. We're already in an X3SA1. So that's where we're at. So if we think that market's going to continue to fall, see, the thing is we were up like $1,000 on the Tesla because it was already up here. Now it's all the way back down to right where we got in, basically, and we're still up 780. So we could take our profits and just put it right back on again. The thing is that we got 133 days, and We got $4,200 on the line. We paid $3,600. It's up that. So we could just take that off. It's volatile, man. I mean, this thing is going crazy. Let's take our profits on everything just to get all of our profits off the table, and then we'll go put some new ones on. All right. So let's come in here and we're going to go to options and we're just going to say exit all options. Now we don't want to do that because we got one we want to keep. We want to keep Bristol Myers because that's actually why I started this lesson today. But I'm so slow. I keep talking about other things. Let's just come into NVIDIA. I don't know. I don't know. Let's exit chart. Take our profits off that one. Would you like to close all options? No, we don't have. Would you like to close all open stocks positions and cancel all open stock orders for this stock as well? Well, I don't have any. No, I don't have any. I don't have any stock positions. All right, so we're going to come in here and Palantir. We're up $245 on Palantir, and it's still flushing. This is X1SA1, X1SA1. I did buy some Palantir right in here on my Yield Max fund. I think I actually in my retirement account, I had a little bit of leftover money on my dividends, and I think I put it into the growth side. So I might be losing on the growth side here. Ooh, I didn't put much though. Mostly I'm in the hedged version. But I had some shares come in, had some dividends come in, and I put it in right in here. X1SA1, just thinking out loud, 25%. So we're coming in and we're going into that X2SA1, which is down here, X2SA1. Now, one of the things that the market likes to do, 55% chance, it likes to touch these moving averages. Now, this moving average is the 200, and that on these markets that do this, those 200 moving averages are really important to them. All right, let's come in here and I'm going to show you also, we got the 100 in here. We'll turn the 100 on and you can see the 100 is being used as a strong area of support right in here. See that? It broke that 100 period moving average right in there, just like a train on rails. And that flushed right there. So that is a good break for that. And we'll probably come down to that 200 period moving average. So we can make a projection. We're going to reverse engineer their formula. Come in here, boom, 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 just like that. And where would that be? That would be your 76.4. Of course, if those two move together and it comes out in here, it might be right up into that. Who knows? Who knows? But that's where it's coming. It looks like right there. If we draw it, kind of push that out there. The intercept on those would be like probably right out in here somewhere, right around that 76.4 number. And then we got that next looming number down here. Who knows? Let's say it does that. If it comes down here, we could take this, and reverse engineer it one more time. Where would it go? Let's say it goes back 50%. And we go up there to that 50% drop. Let's go to 50 like this. And we don't know how far back how long it's going to take it to do that. That'd bring it back to about where it's at right now. So let's just say right now, right at that low point. So let's say there, and then let's say if it does one more drop, we could see Palantir down here testing this level here. Let's say our cone of probability. So if we come in here, let's just go off this point right here, because that looks like that mark. That's where they started to run that thing. And we are sitting right now, we are sitting right dead center of the delta cone of probability. It's been running through that Fibonacci sweet spot for, the last 2 months on Palantir. And this drop today is bringing it right to the bottom, that 61.8 on that, from that low here to this high, that delta cone of probability. We're sitting right inside of that one standard deviation. It's trying to drop out to the 2 standard deviations. I think we will. I think we're going to see it come down here to that 200 period moving average. That will be where I think we'll set our X2SA1 on Palantir. We're up $300 on Palantir. I'm surprised it hasn't taken it off today because this is a really volatile day. Let's go ahead and exit this chart. take our profits off of that one too. Would you like? Don't ask me. If I don't have it, don't ask me. If I don't have it, don't ask me. Only ask me if I have it. Why are you asking me if I want to take off positions that aren't even there? No, leave me alone. Chart, Tesla. Do we want to hang on to Tesla on this position? No, I want to take this off. We'll put it on back on again. We'll take our 780 and we can just go put something else back on. Let's take our options. Exit. Yes. Okay. No, get away from me. Okay. All right. The only thing we got left. So let's see. We got closed positions today. How much did we make today? Today we made $3,620 on our straddles, and we made a little bit more than that because we took a couple of straddles off yesterday or Monday. Can't remember which day, but so a little bit more than 3,600. That's pretty good little strategy. We did okay on that one. We can't complain. So now let's come in here and what are we going to do? I want to show you my spreadsheet because we're going to talk about BMY. Now, BMY is not one of our Magnificent Seven. BMY comes from our Lands Richie Rich Fund. So I'm going to switch over to Lands Richie Rich Fund, which is this one here. And these, I don't know why PFE is in Lands Richie Rich Fund. Well, I do know why. Because I'm not the one that selects what these are. These come out of the 30 top funds or the 30 top stocks by distribution from SCHD. SCHD. Right? So by distribution, SCHD is an ETF, exchange traded fund. A really good one, super popular. And so I took all the top 30 stocks out of that great big fund and the top 10, the next top 10, the next top 10. And that's how I come up with this list. And every now and again, I'll rebalance it, go find out because they rebalance theirs and I'll rebalance mine. And last time I did the rebalance, they stuck Pfizer in there for some reason. I don't know why the heck they want Pfizer in there. But nobody likes Pfizer. All right. So ABBV flushing down just like everything else. We thought maybe we'd get this little projection here, and we're not. It's following the rest of the market flushing out. Let's delete all these drawing tools. Just broke those yellow dots, coming back down into the Fibonacci sweet spot, delta cone of probability. Let's just draw that in there. And so you can see right now, this is where this market's coming to. Now, what are we going to think about this market? We're not going to think anything about it because we're going to go talk about BMY because this is the one we put our position on. All right. So we were hoping against all odds that this market would rally because it had a nice rally. It was making a little pullback. We thought maybe this would break the rules of everything else and go back up, but it's not. Therefore, we're losing money on our long call, but we're making money on our, are we making money on anything? This is a poor man's covered call. So we're up $198 on the call. And this is exactly how YieldMax trades. Well, not exactly. It's a little different than how YieldMax trades, but to some degree, you can almost kind of understand the way YieldMax trades their funds based on this model. So what they do is they'll buy a long call and they'll actually sell some puts down here too to help pay for it to reduce that cost. But I didn't do that part. All I did is bought the long call. So our max loss is $2,715. That's the max amount of money we can lose. And then we're going to come through and you'll notice that this is 133 days. And then this option here is only 7 days. So in 7 days, I'm going to collect a premium of, what was our cost base? $276. So that's why we need a spreadsheet. So if we bring up our poor man's covered call spreadsheet, you can see my idea here. And I've, again, not got it completely worked out, so I'm not giving it to you yet. But if you come in here, what we're going to do is we're going to take this and we're going to have our poor man's covered call is going to be listed here. And then we're going to put all of our covered calls here. And we'll just list them all down through here. All right. So the whole idea here and the math that we did last time was that we take the 275, right? So we take that, and that's how much we paid for that long call. So if we take that $2,715, and if we were able to do 276, how many times would we have to be able to make 200 premium collected? We're going to make 200. Is that what I said? Yeah, $276. So 276 divided by 276 equals 9.8 times. So we would be able to collect 276. Well, we would need to collect nine of them to make that. But how many can we collect? Because it's really time. I'm doing the wrong math wrong. So what we're going to do is we're going to come in here, and this thing, how much time do we have? 7 days. All right. Now, when we bought this, we didn't have 7 days. We had, how many days did we have? 7. So we have 7 days, 7, 8, 9, 10. We have 10 days? 7, 7, 8, 9. We had 9 days. I think 7. Today we have 7 days left. I don't know if it counts today or not. 7, 8, 9. Let's say 10 days. Make it easy. So we're going to say that every 10 days we're going to just keep doing this over and over again. So every 10 days we're going to make $275. So how many 10 days are there in the call, which has 133 days? Does it tell us somewhere where the number of days are total, or just what we got left? Nope, it doesn't tell us. So 133 plus 2. So we had 133, let's say 135 days. Oh, I got it written down here. No, I don't. I thought I had it written down. Oh, I did. 15 days. Oh, I just said 15 days. No, I said 10 days. 10 days. Because it's 7 days left and we had 2 days. So we're going to do 10 days. And then this one here was 135 days. 135 days. So that's why I need a spreadsheet. So we're going to do on the calculator. What we're going to do here is we're going to come in and we're going to say, all right, we've got 135 days. How many 10 days are in 135 days? Divided by 10. I think it was actually 11, if I remember correctly. But there's about 13. That's easy math. So we got 13 of these. So if we can make how much on each one? 276. So if we can make 276 times 10, we can make $2,760. Oh, well, that's going to get us our $2,715. That's going to be our break even. So that's going to be a free trade, but we need the call option to make money. I thought before we had it set up, we were actually going to make a profit on just the calls. But if that's all we can do, cost basis was 276, and we did this one 133 at 275. That just becomes a free trade. So these call options will pay for this call option over the period of the time. See, that's why we need a spreadsheet. And it'll tell us, and the spreadsheet will tell us. Spreadsheet will tell us that. That's why I'm still working on a spreadsheet. All right, so the little calculator, and then it'll tell us whether, but the call's got to be the one that makes the money. And right now the call's losing money. So it'll just be a scratch trade. We'll just have all of our, if the call doesn't turn around and make money, that kind of sucks. So that's a poor man's covered call. That's not going to work. We don't like that. Let me think about that. We're going to have to make that be profitable, because if we can't make that be profitable, even if we lose all of our money on the money received needs to be profitable. I thought we had it worked out yesterday when we put this thing on that it was actually going to make money. It's going to be profitable. Like, did I do something wrong? 200 and no, that's right. 276 days till expiration. How many can we have? Days till expiration 7. So if there's 10 of those, yeah, it's going to come out to be the exact same thing. It's going to be a free trade. I want it to be a profitable trade. I don't want it to be a free trade. We'll have to work on that. Let's go see if we can find another one that'll actually make us money if the call option loses everything. Because that's what we'd like. Man, look at this thing. This thing is flushing like a toilet. Delete all arrows. Look at it. Wow. They're really scaring everybody. We're in despair right now, panic, capitulation. No, we're not in capitulation. I think we're in despair and panic. Everybody's in despair and panic. We've passed fear. We're now despair. I think we're in panic mode. This is a panic bar. Look at that panic bar. Everybody's panicking. We'll get into capitulation here, discouragement, dismay. We still got a couple of feelings to go through. All right. I'm not going to put anything on right now. This Bristol Myers is not even playing nice with us. We'll get our full premium on this one. We'll get our $276, and then we'll just put on another one right at the money. We'll get another $275, and then we'll get another $275, and we'll get another $275. But this thing needs to go up. I don't want to buy a put option today. Not with all that. We'd buy call options today. But this is actually coming in, breaking those blue lights. This is ABBV. That's that little natural trend line shelf. What's the Fibonacci projection? Let's see where we think they're going to put it. That would be right at the bottom of the Fibonacci golden ratio would be 130.9. That's probably where we'll see that thing. My bet is we see ABBV come down here and test the bottom of that cone of probability. Right now, we're just at the very top of the cone of probability. If it's going to do that, why don't you try and make some money on it, Liam? Okay, we could do that. How would you do that? Well, Jeff says, I think that option would be a pain in 10 weeks. The final 3 weeks will be profit. Well, maybe you're right on that one. Where it would have to happen is the market would have to turn on and go back up for that to be profitable. Otherwise, it's just going to be a scratch trade. And all we're going to do is just sit there and collect premium to pay for the loss of the premium on the option. I thought when I did that I must have done my math wrong, because I thought that the way I'd calculated it is that even at the end, even if we lost everything on the option, Jeff, I thought that it was going to come back and it'd still be a profit for us. But now when I redo the math, I don't know why I did the math wrong. I have to go look at my video from Monday or from Wednesday, because that's when we put that on. See what I was thinking. That's why I started doing the spreadsheet, though. That's why I created this spreadsheet. I actually started it, and I've done 3 of them. I've got 3 different sections in here that I'm kind of trying to work it out, trying to figure this thing out, how I want to do it. I've got an old spreadsheet that I've been tracking. Where is it? If I was I was tracking my old, but I wanted to redo it, do a new one. So I didn't like my old spreadsheet. Where is it? It's right here somewhere. Anyway, I have an old spreadsheet that I was using, and I didn't like it, so I started to create this new one. I'll give it to you when it's done, and it'll make these things a lot easier for us. Jeff's saying the final 3 weeks will be profit. 13 weeks total. What did I do wrong? Have you got the math there in front of you? Let's see, Bristol Myers. Oh, see, our cost is, because we can do 13 weeks, 133. Oh, days till expiration. What was our number when we started it? That's the whole thing. I didn't write that down. Or did I? Oh, I think I did. No, I didn't. That's got to be in our spreadsheet. That's got to be in our spreadsheet. We got to have days till expiration. Where is it? Expiration. We don't have days till expiration. Total cost, realized profit. Let's put that right here. So we're going to add one in here. We're going to go days till expiration. Days left. So on the purchase one, it was 133, 134, 135. So that would be 135 up there. I don't want this. I just want 135, you dumb thing. I don't want a date. Stop. Date. Come on. It's just a number. 135. I don't want that kind of number. Down, boy. All right, 135. And then on this one, we said it was 11 days, wasn't it? 7, 8, 9, 10. It was when I bought it, I thought it was 11 days. Ah, stop already. Stop already. All right. So then we need to know how many 11 days are in 135, and that would give us a number that we then multiply by how much money we're receiving from the sold put, which in this case was $276. So I need to not waste your time on that, but I'll work on that and we'll work on it again next time. Probably on Monday. Maybe I'll have that done by Monday. So, okay. All right. Let's go look at something else. There's Cisco. Cisco's flushing out. We already draw that in there. So it's coming down. It's right dead center of the Fibonacci sweet spot at this point. Chevron, same thing. Everything's flushing like a toilet. Coming all the way back down. Home Depot's coming down. This is X2SA1. So this is just broke our X3 coming into the third drive down. Do you think we'll get 4 drives? Let's just worry about 3 drives right now. All right. That's obviously not going to happen. It might still happen. Who knows? Who knows? Nobody knows. Where are they going to bring this thing to? Where are they going to bring this thing to, Jeff? From here to here. Let's go to the lowest point there, back up to here. That next projection is down into here. That's such a long drop. Man, that's a big drop. Went all the way down. That first drop went all the way down 130.9. Just like a train on rails. To 130.9. It's bounced. It's now come back off. And then the next one's down here. 130.9 is clear down there. That's what they're doing. But look at the indicators. This indicator came in, and remember the indicators, this is telling you they're doing their accumulation thing. And then they come in here, and this just, the reason I have MACD on here is because it tells us when it's time for us to get in. Because we're too small. We can't sit here and buy all the times that they buy. We don't have enough money to buy that much, right? So we have to kind of be more strategic about when we start our buying. So I like to use the MACD to help us know when it's time for us to start to buy. And so what I do is when it comes down, this is all red. When it turns green, that's when I start to buy. If I think that the market's going to go up. Now this is X2SA1, and so you got to realize that this only has a 55% chance of going up being the bottom. But it's worth putting a little bit of money in there just in case, because 55%, that's like holding a 17 at the table, right? You don't know if you want to hit or not. It's a hand that's worth playing. So, and with a 55% chance that that's the bottom, I'd like to put a little bit of money in there just in case it wants to go, in case that's the bottom and it goes from here. But now it's broke those blue lights, so we've definitely no longer on the X2SA1. And we're going for X3. So here it comes. Just how far down that scale are they going to let it fall before they do one more accumulation? I don't know. They might go to X4 the way they're letting this market tumble down here. But they just want to get back in. They just want to make money. So they just need to bring the market down so they can have a whole bunch to ride back up the other side. So we're going to go into another accumulation stage, probably down in here. How far is it going to last? We don't know. How far did this one last? Let's just draw our little circle. That one was this long. They accumulated that big. This one was a long accumulation. Let's say they just do that one again. If it starts going down here, let's say that it goes to here. So that would be somewhere right around 61.8, which would make sense. 61.8, that's a Fibonacci golden ratio. So let's say that's where we think this market's going to go. And now it's came on this one here, this Home Depot, it came down slower. It didn't fall quite so tumbly fast. So let's just say we want to be looking for this market to turn around and give us a head and shoulders formation. Left shoulder, neckline. We're going to say that's where our head's going to come to. And then we'll get a little rally, give us another little pop up, and then another little scare, but it's not going to break the head. And then we think it'll go up from there like that. So we can try and reverse engineer what they are thinking, what they're going to do. So that's a model that I think we build out our model and we make our guesses on that. But we don't have to be buyers in here at all. We don't have to be buyers until out in here, until we've got proof that we're making higher highs and higher lows. There's no reason to sit here and try and catch a falling knife and try and get in on all of these downtrends. No reason at all. You could just wait until it turns around. That's the safer bet anyway. It's what I tell everybody else to do. I don't know why I don't do it, but Land, take your own advice. But that's the name of the game, guys. That's where we're at on that one. Let's see if Coca-Cola, that's still going up. It's suffering a little bit, but this is a big one that Warren Buffett loves. And he said he got out of everything. He was smart enough to get out when this market tumbled and fell. He knew that. He reads those tea leaves just like we do. He knows what's going on. But then he said he's starting to put money back in. And one of the things he puts money into is Coca-Cola. So I think that's probably why Coca-Cola is breaking all the rules. Because I think Warren Buffett's kind of putting his money in there. I think he's holding that thing up all by himself. That's little triangle 1, mountain 1. And I think we're going to go in and get another little mountain 2 in here. That might be it for now. And then maybe another little mountain 3 up in here. Who knows? Who knows? Nobody knows. All we can do is make our scientific wild ass guess. Try and play it a little bit. This might be a good place to put in should we put something in here? Let's just for fun. Well, it's not moving very hard. We haven't placed any orders though. Let's come out 133 days and see what the options look like. 133 day, let's do both. Oh, they're cheap. $71 a share. What's the volume on that? Not bad. We could play that. Let's come in here and we'll buy one of these and we'll buy one of these. And we'll ratchet it up to 5. 1, 2, 3, 4, 5. Let's just put this on like this for now. We're going to have to go to, they're going to ask on this, we're buying and buying. So they're going to ask 780. Let's go up to 780. Wait a second. Buy to open. Calls and puts. 780, that doesn't make sense. Why is it doing that? That's not going to let us fill that, is it? Oh, it is. All right, there we go. Okay, so we bought that little straddle. We'll just see how that plays out. Let's go put another straddle on Pepsi. We already prefer. Oh, shit. I don't want to be buying them when the volatility is this high. We'll get a crush. BlackRock. Like a BlackRock. They don't want their own stock to fall. They don't care. It's all a game to them. All right, guys. I think we kind of wore out our time here. I got nothing else to do but sit there and look at this market flush out. So I'm going to go play a guitar or something. All right. If you guys have any questions, let me know. Software I'm using is Track and Trade. You can go get your copy of the software if you want to join me with Track and Trade. If I can move this over here and get out of the way, it's trackandtrade.com. Today we're using the stocks version. If you want to get your hands on this spreadsheet that I'm working on, we'll use it a little bit more so that it makes a little bit more sense what we're trying to do here. Go get yourself a copy of Pit News Magazine. It's on sale right now until I take it off sale. I just haven't had time to take it off sale, but so it's on sale as long as I don't have time to take it off sale. I'm going to take it off sale here pretty soon, but if you want to go take it, I keep saying that, but it's still on sale, 50% off, $19.97, and then you can get this spreadsheet I'm working on. Plus, you get my other spreadsheet too, my UBI spreadsheet. Get both spreadsheets. But I want to work on that a little bit more, and then I want to go and review what we did on Bristol Myers to see what we did. And I'll create that spreadsheet, and then I'll give that to you guys. All right, that's it. I'll come in here and Randy, I got your message. Thank you very much. Randy says that he loves coming to this channel. That made me feel real good to see Randy. So I appreciate the kind words. And for the rest of you guys, James, Kirk, Jeff, Christopher, Kirk, Chad. It's nice to see you all guys all here. Ryan. I haven't said. There's John Gasley. It's nice to see you guys all here. So thank you very much for coming and joining me. Sorry it wasn't a little bit more exciting. I guess watching the market tumbles is pretty exciting, right? But not a lot for me to put any orders on. Took our profits off. We did do that. I don't know if this was a good move. We're already down $112. That was I didn't even look at the theoretical value. Oh, geez. I guess not too bad. We've got them for a bargain, it says. We'll see. We'll see how those turn out. All right, guys, I'm going to let you go, and we will catch you. Have a good weekend. We'll catch you on Monday. We'll review what happened with the rest of today, and catch you on Monday, and we'll do it again. Monday, we get to look at our UBI portfolio because we got paid some dividends. We got to add those in and see if we're still profitable or if we're taking a loss, a hit on our UBI portfolio. The YouTube UBI portfolio. So we'll do that on Monday. All right. We'll see you guys then.